What is going on, guys? Good evening. It's your favorite mortgage lender, Abdel Kwame, Got Mortgages. Happy Monday. The day has finally come. The Federal Reserve has decided to cut their federal funds rate. This has obviously been something that we have been anticipating for a little while. We are going to go over what were some of the Fed comments that they said in regards to their dot plot and what is going to be the expectation as we continue monitoring interest rates and some of the downward trends of what we're seeing. Okay. So again, we all know that the Federal Reserve made its first rate cut for the year. Of course, the biggest driving force was inflation being tamed, but really the job market. We have seen huge cracks in the job market from two revisions on the BLS reports to just the new reports coming on BLS to QCEW showing that they were off by almost a million jobs, 911,000. I want to go through all that and kind of show some of that stuff, right? Starting right at the top, once again, Fed, after 5 meetings, decided to finally cut by 25 basis points. We're at a 4 to 4.25 now. We are starting to see, of course, the biggest thing is going to be the concern of could this potential rate cut obviously now make an impact on the tariffs, right? We know Fed obviously acknowledged again that inflation remains elevated. They did note, though, downside risk to unemployment has risen. Okay. Now, one thing that we did, right, one of the obviously dissents as the new Fed governor, President Trump put in, obviously wanted a 50 basis point cut, while supposedly everybody else stuck with the 25 basis points. Remember, the Fed's funds rate is not the same as mortgage interest rates. The Fed funds rate is the overnight borrowing rate for banks. It doesn't directly set mortgage rates, but again, it doesn't necessarily influence the two. Fed, again, is kind of in that downward, I just said a couple seconds ago, right? They want to maintain that balance on inflation, right? Inflation is obviously something we need to make sure we keep an eye out for, because remember, the last time the Fed cut, literally around this time this year, we saw obviously employment rate jumped up. I think it was 255,000 jobs. We don't want to make that mistake once again. We know, again, it's unclear on the Fed's projection, although they did pretty much estimate that we will more than likely expect to see at least, maybe a potential rate cut at 1, if not 7 expected, there will be none. So we'll see how that goes. Builder confidence has been relatively flat month over month, as we can kind of see since the summer of June. Kind of well expected, I think. Obviously, now that interest rates are starting to subside and start to drop, I think that will probably tend to change. I think as we start seeing a little bit more buyers enter the market. One positive notation that we see here is 8.4% month over month completion when it talks to completions of new construction. That's, of course, a very good thing, because no matter what, we're always in a very tight supply, especially in the East Coast, on my side on Jersey, than we are on a national base rate. 611,000 single family homes that were under construction in August, down again from 2.1% of what it was from July, and 4.8. Retail sales, something we have to keep an eye out for. Remember, our consumers still spending, and they damn well are. Consumers are still spending despite higher tariff rates. Sales gains were broad. 9 of 13 retail sales actually showed increases. Really big leading of obviously online shopping, clothing, and stuff. Initial jobless claims, right? If we see on a initial basis drop by 33,000, right, coming in under expectation, and then we're seeing continuing jobless claims still high, right, 1.92, showing for 17 straight weeks that people who are being let go, a little over just shy of 4 months, are continuously still having a hard time finding employment after they have been let go. Okay. So again, what do we got this week? We are going to get the coveted PCE report, personal consumption expenditure. This is always the most important report when we want to keep an eye on interest rates. We want to keep an eye on what is the Fed's favorite measure on inflation. We'll get a little bit of updates on new home sales for the month of August, existing home sales on Thursday, and again, little updates on GDP report, gross domestic product, and the weekly jobless claims. So quite a few for us to unravel. I want to just take a look at interest rates. As we could see, pretty much since July, I want to say. Yeah, end of July into August, we've been on a pretty good downward trend. We're starting to reverse course a little bit, so important for us to see this. This is the exact same thing that happened, if you guys see here, when the Fed cut, interest rates jumped up very sharply from almost as low as 6.2 to 6.6. Just about 0.4, 0.5% jump. Want to keep an eye on that stuff, right? Because those are the things that the Fed is obviously warning us that could potentially impact the market, okay? So obviously, I will keep you guys updated as always. If you guys have any questions, make sure you guys like, comment, and subscribe to our channel. And let's make it a great day. Have a great day, guys.